The number one rule to remember when you're trading using seasonal patterns is to always confirm the market is following a seasonal pattern. If we take a look here at crude oil, I'll go through what I mean by that. We can see here, this is the 20-year average for crude oil. And we can typically see the market rallies for the first half of the year and declines in the second half. But if you're familiar with the markets this year, and particularly crude oil, you will know that crude oil has not performed anywhere near in line with this seasonal pattern. We can add the current year on top of that, and you can see the yellow line is the current price action of this year, and it has very much deviated away from its historical pattern. So therefore, simply looking at a seasonal chart of crude and saying we are bullish in February or we're bullish in May and expecting it to go up, that's really unlikely to happen. It's not impossible. If we take a look at this year, seasonally, we do see a rally in May. It is a strong performing period, and we did make the low at the same time right at the beginning on the 5th of May, and we did actually move to the upside, but it's a much lower probability move if the market is not following its pattern. That, however, is easier said than done. That's why we've created a really simple tool to help you find the markets that are following their patterns and the markets that are not following their patterns. How we have done that is by creating seasonal correlations. And at the top of the chart here, you can see the 3 primary patterns that we follow as default on the platform. There are additional patterns you have access to and can find. But the 3 primary patterns we follow is the all years for the entire history of the market, the 20-year pattern, and the current election year cycle, which in this year is the pre-election. And straight away we can see with crude oil, the all years is a negative. It's a minus 77% correlation. The 20 years is a minus 74% correlation, and the pre-election year is -5, so we've no correlation here at all. But the 2 main historical seasonal averages, we have a strong negative correlation to current price action. So when you see that, and we've got a negative correlation, you can't be expecting then any upcoming seasonal pattern to actually follow through and behave the way you want it to. We want markets that are following a predictable path, doing what we want them to do, and therefore a much higher probability they're actually going to follow through and behave the way you expect them to during upcoming seasonal patterns. A perfect illustration of this at the moment is that of Chicago wheat. If we take a look at this chart, this time when we look at the historical patterns, we have the 20-year pattern on the chart. And we can actually see on the chart, it indicates based on the last 20 years, the beginning of June is actually a bearish period, and we typically see a move to the downside. However, if we take a quick look at the 20-year correlation, we can actually see there's a strong negative correlation with that 20-year pattern. So trying to be on the short side of this simply based off the 20-year pattern would be incorrect. It would be the wrong thing to do. We're not following that pattern. There's a strong negative correlation. However, if we take a look at the all-year pattern, it's a strong positive correlation with the all-year pattern. It's at 70% positive. We have 64 years for Chicago wheat, so we have a lot of history, and the all-year pattern is showing a very strong correlation. So if we go and actually select the all-year pattern, deselect the 20-year pattern, you can see there's a very, very different formation, and actually add on the current year, and you can see that's exactly what we've been doing this year. And whereas the 20-year pattern suggests we should be negative at the beginning of June, the all-years pattern actually suggests a low here on the 8th, and we see a rally to the upside in the second half of June, an acceleration to the upside. And that's exactly what we have done. So it's a perfect illustration at the moment of understanding when using seasonality, we need to confirm that we're following a pattern, and we need to confirm which pattern the market is actually following, because we do have multiple patterns in all markets. The platform allows you to find which pattern we're following, and if we don't have an obvious pattern, there are tools we can use, the likes or what if functionality and the true path functionality, to help us find hidden and less obvious patterns. But the same principle always applies. We must confirm the market is actually following a pattern, and we have made this really easy to do by simply adding these seasonal correlations. We want to find markets that have a strong positive correlation with their seasonal averages, and they give us a much higher probability that market's actually going to follow through and make it much easier to trade. Check out the correlations for yourself, and remember, on our dashboard we even have the top 20 strongest seasonally correlated markets outlined for you already, all in the plus 80% positive correlation. We even have 3i Group in the 97%, 96%. Really, really strong positive correlations. Trading markets like this that are following a predictable path are going to be much, much easier, and avoid trading seasonal patterns where there's a negative correlation and that market is not following its seasonal pattern.